Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 18th, 2023. I hope you are doing well. I hope you're having a good weekend, and I appreciate you stopping by and to watch my weekend review podcast. In this podcast today, this is the format. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the positions that I was involved with last week. We're going to talk about when I bought them, why I bought them, what time frame I bought them on, and most importantly, how I am going to manage the positions going forward. After that, we are going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and then to follow that plan without letting the gains or the losses of the trade affect and amplify your emotions and get you off track. So it's very important to stick with your process, stick with your plan, and of course, psychology is a large part of that. And so I'd like to talk about that. Hopefully it will be helpful for you. It's always helpful for me to talk about it and discuss it for my own trading as well. After that, we are going to do a poem from my friend Frank, the trading poet. Always great poems, always pertinent to what's going on in this week's trading, and so we'll do that. And then after that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames, and I have identified some positions and some levels on markets next week that I would be interested in getting long or getting short. And so I will go through those with you and show you what I'm looking for, give you an idea of how I view trading and how I identify levels and rejections of levels, and to put myself in the best position to have a positive trade. And like I said, we'll do that both on the daily time frame and the weekly time frames as well. With the weekly time frames now, the weekly bars close on Friday, so the decisions are made on Friday. And as you'll see today, when I go through my positions, I have positions both on the daily time frames and the weekly time frame. So hopefully this will be helpful for you. I've had a lot of emails lately telling me thank you. They've got some really good trades looking at the positions that I've been taking, and some people have been taking these trades. And again, not this is not for, my intention is not for you to take these trades. My intention is just to show you how I trade and the levels that I look for. All right, so that's the podcast, the format of the podcast today. Let's start off real quick with the U.S. legal disclaimer, and I will be back in about 45 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me. And first of all, we're going to take a look at the trades on the daily time frames. Now, I'm going to show you why I took the trade, how I'm managing it. There's a lot of rules that I follow, especially in the management section of the trade. And I'll do my best here to explain, what the rules are. But due to time constraints, I can't do it for hours because that's really what it takes to learn all these rules. But I just want you to know right up front, I do teach private one-on-one lessons in the evening time via Skype. I teach you all 5 of the different trading approaches that I use step by step. It's a great course. I have taught students from all over the world for years. They've all been very happy with the results. So if you are interested in becoming a student and working one-on-one with me, all you have to do is send me an email. The email is in the link of this YouTube video, and reach out and say, hey, Greg, potentially interested in taking your course. I'll reply back, and we can get the process started. But it's a great course, and you really will learn a great skill, the skill of trading, and everything I teach. Really good trading principles, position sizing, emergency stops, end-of-day stops, all this kind of stuff. All right, so keep that in mind, and I'll talk a little bit more about it as we go through the podcast. So first of all, QQQ. All right. Well, the key to trading, in my opinion, and I've been doing this for 28 years, is you have to find levels that you believe that other buyers are going to come in. That's the first thing. Whether that's a 30 RSI, whether that's a 200-day moving average, a 250, a 300, these tend to be levels where other buyers come in. And if you have more buyers coming in at a certain level, it will increase the possibility of you having a profitable trade. That's one of the advantages of doing that. The second advantage of doing that, it gives you a very definitive line in the sand. If it's over this level, I'm in. If it's under this level, I'm out. Risk to reward is so important in trading. It really is. Position sizing super important as well. And I took a new trade this week on Verizon. I'll show you exactly how I position size based upon the current market volatility. But looking for those levels, in the 28 years that I've been trading, looking for those levels. If they reject those levels to the downside, I get on in. I also want to make sure they're kind of trying to reject some kind of level on the higher time frame as well. If I'm trading daily, I also look to the weeklies, and I'll show you that when we go through the potentials for next week. And then if it closes under that level, just get out. Human nature, I understand you don't want to get out. We're always hopeful. Oh, I think it'll go back up. Yeah, sometimes it doesn't, right? It's really true. Sometimes it loses that level and just keeps going. And then you're in a tough spot, because if something's low and you think it's low, well, it can always go lower. So you have to get your ego in check. When you're wrong, you're wrong. You can always get back in if it goes over. All right, so let's start with Qs. So where was the level that I was looking for? Where did I think other buyers would come in? Where was my line in the sand? Well, here we go, Qs. I bought Qs back on the 13th of March. Why? Well, simply because we closed under the 200-day and over the 200-day. There's a good chance that buyers are going to come in here. They're going to be thinking the same thing that I did. And you can see on this day, we opened way down. We went way down, and then we closed over the 200. Well, it rejected the level that I was looking for. It also gave me a very nice risk to reward ratio. If in the future, the next day, it had closed below the 200-day moving average, even a penny, I would have gotten out. That is my end of day stop. So the reason I took this trade was to close under the 200, over the 200, the rejection of the level. So first thing I do, I position size, and I'll show you this on Verizon. I'll show you exactly, but I position size based upon the current market volatility. Basically, I take 1% of my total capital. I divide it by the value of the two ATRs. That tells me how many shares to buy. And then, so I have two stops. End of day stop. If we close under 200, out, no questions asked, that's it. And I put my emergency stop down here, 2 ATRs below, so that if it does get down there, I only lose 1% of my total capital. That's the worst case scenario. But 95% of the time, the worst case scenario is not going to happen. And 5% of the time, it will get down to your emergency stop. It does happen, happens all the time, but not that frequently, only about 5% of the time. So that is why I entered. I entered at 290.50. I did not know it was going to go racing up like it did, but I put myself in the position for this to potentially happen with this rejection of this 200. So I did enter at 290.50. I position size. I placed my emergency stop. I know where my end of day stop is, closed below 200, but fortunately it went my way. Now, another part of my trading process is if it moves up a certain amount, actually the amount is the value of the 0.45 ATRs from the previous day's close. That's my first profit target. Then I'm going to take a partial position off, take 10% of the position off. If it moves 0.9, if it moves 2.45s, then I'm going to take another 10 positions. So I like to play offense and defense. The defense is knowing where my emergency stops are, knowing where my end of day stops are, trailing stop, my trailing stop process that I'll use and I'll tell you about here in a second. Those are all defensive moves, but the offensive moves are taking partial profits when the market gives them to you. It's very important. I think it's very To have a well-rounded approach, you need to play offense and defense just like in sports. So got long here, 290.50, moved up, took some profits. Next day, didn't do much, no profits. Next day, took some nice profits, took two profit targets into that strength. Now, orange line here, this is my 1.5 ATR trailing stop level. This is 1.5 ATRs above my entry point. Once I get there, then I get into trailing stop mode. It doesn't mean I do anything, but now I'm in trailing stop mode, meaning that if I, in the future, after reaching my trailing stop mode, 1.5 ATRs above my entry, then if I have a close below a previous bar's low, then I get out of half of the position. Now, I love to take half profits when my strategy tells me to, because taking half of your profits is one of the only win-win situations in trading. If you take half profits and it keeps going up, you're still happy that you have half. If you take half profits and it goes down, you are really glad that you sold half. Does that make sense? So anyway, this particular trade at this point is up 4.87%. It's been a really nice trade. Now, if we get into the 65 RSI levels, then the 5 EMA will come into play as a trailing stop. If I reject the 70 RSI, I will take another half of my position off. If after rejecting the 70 RSI, if I have a close below the previous bar's low, then that will conclude the trade. So QQQ's really nice trade. Just want to point out here again, really good risk to reward ratio. And that's the key in trading. If you're wrong, be wrong small. If you're right, have a process that you can have a large outsized win, because in trading, you need to have significant large wins to pay for all the little losses that you're inevitably going to have in the trade. So Q's, great trade. Also a V1 here, by the way. Forgot to mention that. Yes, we closed under the 200, over the 200, but we also had a V1. And again, V1s and V2s are something that I use in my trading. They're really the bread and butter of my trading. I teach this in my one-on-one course. We go through it for hours, but really a good approach, and it's key in trading that you have multiple signals. A close under 200, over 200, yes, that's good, it's legitimate, but if you can combine that with a V1 or a V2, then it really improves the chances of your trade working. Doesn't have to work, but it improves the chances. And so this is what I teach in my one-on-one courses. And by the way, I have a link in the description of this YouTube video here for V1's V2 entries. It's totally free. It's on my YouTube channel, and I think it's about 50 minutes, and it's a great video. If you have a chance, watch that. It will explain what V1s and V2s are. So V1, I'll just go over it real quick. V1 consists of two bars, bar 1, bar 2. Bar 2 has to go below the low of bar 1 by a quarter ATR and then close above bar 1's close. Well, it did that in conjunction with closing under the 200 and over 200. So that was my confluence of signals. Worked out great, up 4.87% so far. All right, Goldman Sachs. Well, Goldman Sachs been a lot of volatility in the market with banking lately, and this was a losing trade. I did buy Goldman Sachs back here on the 10th of March with an under 30, over 30. This is a deep dip buy approach. I position size, I put my emergency stop as always 2 ATRs below. And then my end of day stop would simply be a close under the 30 RSI. Well, that did happen, and I did have to get out for a loss of 3.96%. But you can see we are much lower than that now. So even though it's not fun to take a loss, when you do take your stop loss and then it's much lower, you're like, oh boy, thank goodness I took my stop loss, and I'm very glad that I did. So Goldman Sachs, along with all the banks, with all the liquidity issues with the banks last week, really moved down. Thought I'd take, I didn't think, oh, I have a feeling it's going to go up. I just went from my technical signals, and it did go under 30 RSI and over 30 RSI, and over here, sorry, under 30 RSI and over 30 RSI. And then the next day it just didn't hold. I just got out, no questions asked, moved on, and looking for a better trade. But this was a loss of 3.96%. Netflix, okay. Confluence of signals here on Netflix. I took this trade back on the 14th of March. We went under the 30 RSI during the day, close back over. That is one deep dip by signal. We also went under the 300-day moving average during the day, closed back over. And we also went under the negative third ATR channel here. 92% of prices, when you go under the negative third and over the negative third ATR channel, tend to at least go sideways or bounce. So there was a triple convergence here of why I took the trade. Again, intraday under 30, over 30. That's one. Intraday under the 300, over the 300. That's two. And then under the negative third, back over the negative third. That is three. So as always, I position size, taking 1% of my total capital, dividing by the value of the 2 ATR. That tells me how many shares to buy. I place my emergency stop, which is exactly the same value as the 2 ATR, below my entry. And then my end of day stop is simply going to be a close under the 300-day moving average, giving me a very good risk to reward ratio. I don't know if I'm going to be right, but I have the potential to be right big, and most likely potential, if I'm wrong, to be wrong small. I took the trade here 294.20. Next day, immediately moved up, took some profits off the table. Next day after that, moved up again strongly, took some profits off the table. Orange line here again is my 1.5 ATR trailing stop level. Got there. Now I'm in trailing stop mode. Now if I have a close below a previous bar's low, I'm going to take half. Well, Friday, Netflix was down 2.12%. But do you see how, yes, during the day it did go under the low, but it closed back above the low. So I took no action. It has to close below the low. Makes sense? And I should mention that I make all of my buying and selling decisions at the end of the day. The end of the day, I feel, is the most valid time to make your buying and selling decisions because it's the most valid price. Because at the end of the day, you have large financial institutions coming in, moving the stocks where they believe the correct value is. So I always wait for the end of the day to make my buying and selling decisions, with the exception of one thing, and that is my emergency stop. If I get to the emergency stop, I don't care if it's 1 minute after the market opens or 1 minute before the market closes. If it gets there, I don't wait for the end of the day. I just get out immediately because I have hit my maximum allowed loss possible. And I don't go, well, maybe it's going to go back up, or, oh, maybe this or maybe that. No, if it gets there, I just get out. That's the important part of being disciplined in trading. But thankfully, did not get there. Moved up nicely. So far, this particular trade is up 3.06%. All right. Let's go to Philip Morris. Philip Morris. I had a lot of hope for this trade, but goes to show you, even if you have a really, really good setup with a lot of confluence of signals, it still doesn't mean it has to work. I did buy Philip Morris back here on the 15th of March. Nice, beautiful, under 30, over 30, under the 200, over the 200, under the 300, over the 300. Really like that trade. I got long here at 96.08. Position size, emergency stop down here, 1.5 trailing stop level up here if it ever gets there. But the very next day closed under the 200, and I had to get out with a very small loss, 0.79%. That's it. That's all it takes. I didn't struggle and go, oh, I think it's going to go back up, whatever. And then Friday went down again, even further than where I got out. So glad that that happened. Although next week, if we get back over the 200, I would be interested in getting in again. So a loss of 0.79% here on Philip Morris. Verizon. All right, this is a new trade that I took on Friday. Nice setup here. Doesn't mean it has to work, right? I go into every trade just assuming it's not going to work. Not to be negative. This is something I learned from studying with Larry Williams. Larry Williams says one of the keys in my trading, Greg, is I assume every trade's going to be wrong. And I'm not being negative. I just want to prime myself so that it helps with my ego. If I think it's going to be a bad trade or it's not going to work and then it untriggers my entry, then it's easier for me to get out. If I think going into the trade, hey, this is going to go up, blah, 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 then I may not follow my rules And so it's just a mindset, right? And I do that. With every trade, I go, oh, I assume this Verizon trade is not going to work here. Yeah, I just assume it's not. So if it doesn't work, then I can get out and it satisfies my ego. Makes sense? I know it's kind of a weird thing, but it works. It really works. It helps you to get out of your trades, and that's the key, to get out of your losing trade quick. So whatever kind of mind games you have to play yourself. So anyway, this is Verizon, multiple confluence of signals here. During the day, we went under the 30 RSI, closed over the 30 RSI. That's the main signal. But we also have a V1. Remember, I just mentioned V1s consist of two bars, bar 1, bar 2. Bar 2 goes below the low of bar 1 and then closes above the close of bar 1's close. So I entered here 36.69. It's in the money, 10 cents at the moment. And let me show you how I position size. Very important part of trading. If I had to say the most important part of trading, if I had to just only could say one, it would be position size. Because if you have a huge position size and you're wrong, well, then you're toast, right? But if you have a reasonable position size based upon the equity that you have in your account, then a loss is not going to really damage or send you into spirals, right? So let me show you. Let's just say we have a hypothetical $100,000 account. 1% of that is my maximum allowed loss. If you have a $500,000 trading account, then 1% is 5,000. If you have a $50,000 trading account, 1% is 500. So whenever you get into a trade, the most important thing first, and the way that I do it, take 1% of your total maximum allowed, 1% of your total capital. Let's just say hypothetical $100,000 account. $100,000 account times 1% is $1,000. Now, I take my $1,000 and I divide it by the value of the 2 ATR. Currently, the value of the 2 ATR up here is 1.33. So 1,000 divided by 1.33 tells me to buy 751.87 shares. Well, I can't do that. I have to round up. I would buy 752 shares. Okay? And that's taking into account the volatility. If volatility is higher, it's going to have you buy fewer shares. If volatility is lower, it's going to have you buy more shares. So now I know exactly how many shares to buy in this hypothetical situation, 352 shares. So I see the entry, under 30, over 30 with the V2. Makes sense. I like the sideways motion here, by the way, and the undercut of the low. So I buy 752 shares at my entry price. Now, I place my emergency stop. How far below? Well, we just did the math. We took 1,000 divided by 1.33. So therefore, I put my emergency stop 1.33 below. If it gets there, that's in the worst case scenario, then I will lose the $1,000. Doesn't matter how many percent the way down there, because taking your maximum allowed loss, dividing by the 2 ATR, you just know if it comes down here, then I'm going to get out and I will lose that hypothetical $1,000. Now, most of the time, you are not going to lose the $1,000. Most of the time, your end of day stop will kick in. So the emergency stop's 2 ATRs below. End of day stop is where am I going to get out of the trade? Well, why did I take the trade in the first place? I took the trade in the first place because it went under 30, over 30. So therefore, in the coming days or weeks or whatever, if it closes under 30 RSI, I will get out of the trade. Most likely that will be higher than my emergency stop. So emergency stop, 2 ATRs below, end of day stop, a close under the 30 RSI would be my end of day stop. And that's essentially just reverses why I took the trade. I took the trade because it went under 30, over 30. So if it closes back under 30, then I'm out. I just realized that the trade was incorrect, and I just get out and wait for a different setup. Now, 1.5 ATRs above my entry is my trailing stop level. If we get there, then I go into trailing stop mode, right? Which means then in the future, if I have a close below previous bar's low, I just get out. So I like the trade here. Beautiful V1, beautiful under 30, over 30, undercut of this previous range here. So lots of nice things going on here. Doesn't mean it has to work, but that's the new trade that I took on Verizon, and it is, well, I guess, let's see. Just do this quickly. closed strong too, which was nice. All right, this particular trade up 0.27% so far. So those are the dailies. Now let's go over to the weeklies. Boy, I had a monster trade on AMD here. Boy, I'd say I did. I bought this back here on the 24th of February. Okay, just a little review. I want to look for a major level that gets rejected, that gives me a good risk to reward ratio. Well, here, I bought this on 224Y on the weeklies. Remember, this is Fridays at the end. So a few weeks ago or a month ago, we had a huge rally up. Now we pulled back and we bounced at the 200-week moving average. There should have been some support there, and there was. I position size, place my emergency stop 2 ATRs below. Where's my end of week stop? Well, I took it because it bounced to the 200. So if it closes under the 200, I'm simply going to get out of the trade. Well, luckily it didn't. It never closed below the 200 and just moved up strongly. Remember, I take partial profits. Didn't have any the first week. After the second week, I had some great profits to the upside, and of course, this week was a monster and took several profit targets off on the way up. Remember, playing offense, selling into strength. Got to trailing stop level, obviously. Now, if I get a close below a previous bar's low, I will get out of half. But again, I was talking earlier about the rules that I teach in my one-on-one course. Well, this has triggered in AMD. If I get to the 65 RSI level, now the 5 EMA comes into play. That will be a tighter stop for me. And so therefore, in the future, if I close below the 5 EMA, I am completely out of the trade. Conversely, if we move up and reject the 70 RSI, then I will take half of the position off. And then if that happens, then if I get a close under a previous bar's low after rejecting the 70 RSI, then I will be completely out of the trade. I know all these rules sound complicated, but to someone new, they're complicated. Yes, but again, in my course, I will drill these into your head. You will know them like the back of your hand. And that's one of the advantages I believe in really studying with someone in a one-on-one setting, because it's very important to me that my students succeed, and I will ingrain all these rules in your head, and trust me, you'll be glad that you have these rules because they really do work. This particular AMD trade currently up 21.14% on the weekly trade. Really good trade. Very happy for that. UNG, okay, this one not so hot tamale, but the trade is not over. I bought UNG, which is natural gas, back here on the 24th of February. The signal was an under 30 RSI, over 30 RSI, combined with a V2 entry trigger, like the signal. Position size, placed my emergency stop down here at about $6. My end of week stop in this particular case is what? Well, I took it with an under 30 over 30, so therefore I will get out if we close under 30 RSI. Right now we are at 31.73, so I continue to stay bullish on this trade. It is down at the moment, but is holding my level, so I'm going to continue to stick with the trade until either it closes under 30 RSI on a weekly basis or it gets to my emergency stop. Currently, this particular trade down 8.97%. Tesla. All right. Well, so far so good on Tesla. Why did I buy Tesla? I bought Tesla back on the 10th of March with a bounce at the 200-week moving average. I talked about Tesla up when it was way up here. I was like, I'm not going to get in this trade until it comes back down to an identified level that I believe buyers are going to come into and that will give me a good risk to reward ratio. Well, that's exactly what happened. Came and bounced at and closed over the 200-day moving average. I bought at 173 even. Position size, place my emergency stop below. My end of week stop is simply a close below the 200. You can see last week it clearly closed above the 200, so I am still in the trade. And this particular trade up 4.16%. Orange line up here, that's my trailing stop level. If I get to this trailing stop level, then I go into trailing stop mode. Not there yet. So right now, looking for any close under the 200 week to get me out. If we continue up, which it did this week, is, I bought this here at 173. It moved up at least 0.45 ATR. So I did lock in some profits on the way up. Market can't take that away from me. Even if next week we come crashing back down, I still am going to mitigate that loss because I took partial profits. And if it keeps moving up, great. I have no problem that I took some partial profit. If it continues to move up, I will continue to take partial profits. Remember, offense and defense, you have to play them both. But the main thing I'm concentrated on here is a close below the 200 would get me out of the trade. But this trade up 4.16%. IWM, boy, I've been in this trade forever. But it's a good teaching moment here, showing you why it's important to take profits when you have them, why it's important to have a trailing stop methodology. I did buy IWM all the way back here, October 14th of 22. I identified the level of rejection of the 300-week moving average, giving me a very good risk to reward ratio. Of course, I have my emergency stop, 2 ATRs below. And then my end of day or end of week stop in this case would simply have been a close below the 300. Remember, I take profits on the way up, moved up the next week, took profits, moved up the next week, took profits, no profits the next week, had a huge move up here, got to trailing stop level, meaning that then if I have a close below a previous bar's low, I'll get out of half. This happened here on the 9th of December, got out of half at 178.70. for approximately a gain of 6.72%. Now it came back down. Then we had this other nice leg up where I continued. I took some nice profits here. I took some nice profits here. I took lots of profits into this move up here. And now I'm left with fewer shares, obviously, because of the scaling out into strength, the trailing stop level here. And am I glad that I did that? Oh, you bet I am. I mean, I sold some way at the top. I sold some here, right? And any of these moves up into here. Well, look at this. I almost had to get out of my trade with the close under my under the 300-day moving average. It still would have been higher than my entry point, but that is my end of week stop, is a close back below under the 300. But it did bounce and hold at the 300. So next week, if we close under the 300, I am out. That's all there is to it. So on the remaining shares that I have left on IWM, up up 2.58%. All right, last but not least, QLD is a short position that I took way back here on the 3rd of February. Why did I take it? Well, we had a rejection of the 200-week moving average. I got short here, 46.10. Now, a short position, I'm going to place my emergency stop 2 ATRs below. My end of week stop is going to simply be a close over the 200-day moving average. My trailing stop level is 1.5 ATRs below my entry, and I cover partial portions of the position on the way down, just like I sell into strength if I'm long. I cover into weakness, and you'll see why this has worked out was a good plan, and this is a good example of it. So I got short here, 46.10. Next week, we went down. I locked in some profits. Next week, didn't do anything. Next week, went down, locked in more profits on the way down. Next week, no profits. Then 2 weeks ago, had a huge move down, locked in more profits. Now, this week, got to the 1.5 ATR trailing stop level, meaning that if I get to this level and I'm short, if I have a close above a previous bar's close, I'm going to get out of half. And that's exactly what happened. It did fine. We had a big week to the upside. It closed above the previous bar's high, and that was my signal to lock in half. So currently this position up 2.67%, but remember we had the big moves down where I did lock in profit. So it's a good example of whether you're long or you're short, why selling into strength, covering into weakness is a good part of a complete balanced trading approach. Now, where is my end of week stop on this particular trade? Well, I took it because we rejected the 200. If it closes back over the 200, then I would get out. But anyway, so far, nice trade, up 2.6% remaining on the shares, up 2.67% on the shares that I have remaining, but up more than that on the trade because I took partial profits on weakness. All right, let's do a little trader psychology. This is from Money Trade Edge, Better Thinking, Better Trading over on Twitter. Great channel. Love his post. Do yourself a favor, subscribe to Money Trade Edge, Better Thinking, Better Trading. And let's read what they have to say today. Trading is fast. Often you don't have time to think and your emotions take over. Just follow your plan. Pretty simple, but carries a lot of weight and wisdom. Trading is fast. You know, when the market's not open and you look at it, it's trade set up, you're like, okay, if it does this, I'm going to do that, and if it does that, I'm going to do this. But sometimes when the lights are blinking and your emotions are revved up and amplified, then that kind of goes out the window. You make these impulsive moves like, oh, I think that's enough, or I don't think it's coming back, so I'm just going to get out. And then it does come back. You're like, why didn't I follow my plan? Following your plan is so important. It really is so important, everyone. I interviewed Michael Lamothe a few weeks ago, and he did a deep dive in his numbers. And he said, last year, Greg, if I would have just followed my plan, I would have been, I think on average, about 30, his returns would have been 30% higher than if he had not followed his plan, by not following his plans and being impulsive. That's significant. And it's easier to follow your plan emotionally because you don't have to make all these split-second decisions. That's exhausting. It's a lot more holistic way to trade by just following your plans. And if you're following a trading plan using good trading principles and everything's covered in there, then that's the best way to trade. Just get yourself away from making impulsive decisions, whether or not you have to have your partner help you with that or your friends or something, whatever it takes, man. Follow your plan, because making these impulsive decisions in the middle of a trade in the long term are going to hurt you. They really are. So, I thought it was a good segue with interviewing Michael Lamothe about him. His returns would have been 30% higher if he would have just followed his plans. Yes, sometimes impulsively you're going to get out and then it continues down. You're like, aha, you see, I did make the right decision. But that's an isolated event. There are many times I've made impulsive decisions like, oh, it's too high. It just keeps going higher, right? Things that go high can go higher. Things that go low can go lower. So I'm imploring you, I'm begging you, come up with a trading approach and a trading system and stick with it come hell or high water. It's really important. And if you don't have a good trading approach, in my one-on-one courses, I will teach you really great trading approaches that encompass all of trading: stops, taking profits, overhead resistance level, emergency stops, confluences of signals. So if you don't have a trading plan or you want a new trading plan that's really good, that's what I teach in my one-on-one courses. So one more time, trading is fast. Often you don't have time to think and your emotions take over. Boy, that is true. Just follow your plan. Your returns are going to be better. Your mental makeup is going to survive better. It's going to be in better shape. You're not going to have to make all these split-second decisions. And just all in all, you're going to make more money. So which one's better? Be more stressed out, always have your feet to the fire, make less money, or be more relaxed, make more money? Which one's better? Following your plan's better. You just need to get yourself a plan, and I can help you with that. Okay, before we get over to looking at next week's potential setups, just want to do a quick poem for my friend Frank. You can follow Frank at FrancoD over on Twitter, the Trading Poet. Great trader, great musician, great journalist, and great poet. Let's see what Frank has to say today. Markets paint colors of red and green. Yes, they do. Markets paint colors of red and green. The first hour of trading is an active machine. It certainly is. Institutions buy at the close, as we have seen. That's when we buy too, as part of our routine. Meanwhile, we'll take a leprechaun and some luck in between. Told you it was pertinent to St. Patrick's Day, right? And to what's going on. Yes, this is exactly right. Markets paint colors of red and green. The first hour of trading is an active machine. Institutions buy at the close, as we have seen. This is what I've been talking about. This is why I buy at the end of the day. I feel like it's the most valid price. These large financial institutions, they're dealing with the most money. They have very smart people, the best technology, the best information, and therefore that closing price is the most important part of the day. You want to make your signal entries and exits based upon the most valid price, and that's why the end of the day price is the most valid price, in my opinion. So institutions buy at the close, as we have seen. That's when we buy too as part of our routine. That's exactly right. That's when we buy too as part of our routine, because that is the most valid price. Meanwhile, we'll take a leprechaun and some luck in between. That wouldn't hurt either. So thank you very much, Frank. Great poem. Happy St. Patrick's Day. And you can follow Frank at FrankOD over on Twitter. All right, let's get to the most important part here, and these are some potential trades that I'm looking for next week. Now, I'm going to go through potential setups on the daily, and then also on the weekly. But let's start with the daily. Well, Berkshire Hathaway really taking it on the chin over the last couple weeks, but it has come down to a level that's interesting to me. The 200-day moving average. Now, on Friday, we closed under the 200, so it's not a valid trade right now. Now, you see this line that I drew with the 200. The reason I do that is because I want to show you some levels on the weekly as well. So it's important to look for a confluence of support levels on 2 time frames. If I'm trading the dailies, I want to look to the weeklies. If I'm trading the weeklies, I want to look to the monthlies. So I drew the line here at the 200-day moving average. Let's go to the week and see where that lines up. Well, that lines up about at the -1 ATR channel. This is the value zone in here. If we could get above that value zone level, that would be important. It would show you on the weekly that the -1 ATR channel has been rejected. So next week, what I'm looking for a close over the 200-day moving average. I'm looking to see that price is under the 200. If there's no more sellers and it bounces, then it tells me that, at least in the short term, that no one wants to sell under this 200-day moving average. So if it has a nice gentle close over the 200, then that's a potential for me to get long there. And then my end of day stop would simply just be a close back under the 200. Hopefully for a small loss. If I'm right, then hopefully it moves up. I can take partial profits, get to my trailing stop level, all the stuff I've talked about before, taking partial profits and so forth. So I really love Berkshire Hathaway as a company, but technically it is not strong enough yet to get over the 200. So for a potential trade for me next week would be a nice gentle close over the 200, showing me that prices under the 200 have been rejected and giving me a good line in the sand for my end of day stop. So Berkshire Hathaway potential entry with a nice easy close over the 200-day moving average to give me a good risk to reward ratio. Caterpillar, ooh, my gosh, look at Caterpillar. This move down, my gosh, just straight down. But we're coming into some important levels to the downside, 200-day. Now, you can see on Friday, it didn't quite get there. It did not quite get to the 200-day moving average. If it does, it either bounces, goes down, bounces, or intraday goes below and then closes above, or alternatively, closes below and then closes back above. That will be my entry point. This is a deep dip buy stock trading strategy. This is what I teach in my one-on-one courses. One of them. I teach 5 different approaches. Now, I drew the line here at the 200. Let's see what that looks like on the weekly. Dovetails really, really nice with the 50-week moving average. Remember, some people just trade weekly bars. There'd be some buyers possibly be some buyers coming in at the 50 and actually the -2 ATR channel. So that's an important level on multiple time frames. So next week on Caterpillar, potential trade if we bounce at the 200 like we almost did this week, not quite. So a bounce at the 200, an intraday rejection of the 200, or a close under the 200, over the 200. would get me potentially long on Caterpillar. Dow Jones, well, of course, this is our Dow Jones Industrial 30 Index. Big move down, a lot of money flowing out. Now, where's my level? Well, a close over the 200 would be potential, but it's not really what I'm looking for. I am looking next week, especially on an index like the Dow, if we go under 30, over 30. That would an intraday under 30, over 30, or alternatively a close under 30 and close back over 30. I really love to buy under 30, over 30s on indexes, even more than just individual stocks. And next week we have the Fed meeting. Who knows what kind of nonsense and shenanigans, what the market's going to take. Are we going to raise 25 basis points? I think there's about a 75% chance that's going to happen. There's also, the market has priced in a potential pause, no interest rate raise at all, especially in light and context of what's going on with the banking industry at the moment. And then even some banks are forecasting a cut. Nomura came out, believes they're going to be a 25 basis point cut. Who knows? Doesn't matter. What matters is that you take your signals based upon the technicals. The truth is in the technicals, not the talking heads on TV, not the pundits, not the, the so-called stock trading gurus. I've been doing this for 28 years. Just get rid of all that stuff and just do what the market's doing. Do what the markets are telling you. And if we go under 30, over 30, then the market has spoken. That is the truth. So I'm looking next week on the Dow for an under 30, over 30. That would be my potential entry signal on DIA. Russell. Well, I already have Russell on the weekly trades, but look, we're at a 3139 RSI, very similar to the Dow. If the Russell goes under 30, over 30, that would be a good low risk to reward trade to take, especially on the index, and IWM is an index. So for next week, IWM an under 30, over 30, or a close under the 30, close back over the 30 would be my entry signal on IWM. Morgan Stanley, well, a lot of volatility in the banking system. We are currently under the 200-day moving average right now. Morgan Stanley, big bank, had a huge move back down. Does give some opportunity to us on such a big and large company as Morgan Stanley, but I still need the technicals to confirm this. Well, a close over the 200 would be a really good risk to reward ratio. And look, we're at a 2812 RSI. If we got back over the 200, we would also get back over the 30 RSI. And that is a wonderful confluence. An under 30, over 30 at the same time you have an under the 200, over the 200. Doesn't mean the trade has to be profitable, but it sure improves your chances and gives you a good risk to reward ratio. So I drew the line here at the 200. Let's see what that looks like on the weekly. On the weekly, back here at support level, which is definitely something. And look, we're under the 50-week moving average. If we got back over the 200 on the daily, we would have also got back over the 50-week on the weekly. So confluence of signals. So I really do like this trade. I'll be looking at this carefully for next week for a close over the 200. Philip Morris, well, this is a trade that I took, and I had a loss of 0.79% last week, had a small loss, but if I get another close back above the 200-day moving average, I will take another trade in this. And good time to point out, if you take a trade on Apple, for instance, and it untriggers and you have a loss, and then you take another trade on Apple and it untriggers, they have a loss. Human nature is you kind of like, oh, I'm done with Apple. I'm going to go to something else. But the correct way, in my experience, is if you get a signal that you take and then you have to get out, then you get out, take another signal, even though you don't want to. If you have a loss, get out again. But if you get another signal, don't hesitate to trade that signal if it's a proper signal. A lot of people just give up, and then the one signal they don't take is usually the one that goes up. You've been there, right? So perfect example on Philip Morris. Took a trade, had a loss. Well, if it closes back above the 200, I would definitely take another stab at this. And, in addition, we have a beautiful double bottom bullish divergence going on here. I studied one-on-one with Dr. Alexander Elder, and his favorite technical indicator are double bottoms bullish divergences. Now, they don't happen very often, but they're happening right now. Look at this low here. Look at the deep red MACD bars. Then we rally. We have some green. That's a requirement. Now we've come back down. Are we lower than this low? We absolutely are. Are these deep red MACD bars as deep as these? No, not quite. That means there's a divergence going on here. What that really means is that there was a lot of downward momentum here, and as shown by the deep red MACD bars. Now we have another huge down bar here, but the bars are not as deep, meaning that the momentum was not as strong as the first move, and therefore the implication is that you're running out of momentum, you're running out of sellers, and with potential of a bounce here. So we did go under 30, over 30 on Friday. Technically, could have taken this trade. That would have been a valid trade. I did not take it. I took Verizon instead. But if we can get back over that 200-day moving average next week with a nice gentle close above, not if it goes racing up, I'm not going to, because then it doesn't give me a good risk to reward ratio, right? But if we have a nice gentle close above the 200 to give me a good risk to reward ratio, I would get potentially long Philip Morris. UAL. Well. This is one of these stocks that has gone from 70 RSI all the way back down to 30 RSI in one move. Incredible. Unbelievable, really. Well, what am I looking for? What do you think I'm looking for? Well, I'm looking for a bounce, the 200-day moving average. A bounce or an intraday rejection or a close under, close over. Drew the line here, 41.50. Let's see what that looks like on the weekly. Support of the -1 ATR channel there. So that is what I'm looking for. Next week, potential buy, been a huge move down here. Are there going to be some buyers coming in at the 200 like me? It's potential, probably. I would imagine. Doesn't have to happen. But again, I want to put myself into a trade where I believe a large group of buyers are going to come in. And I believe that the 200-day moving average has a good potential that buyers are going to come in. I'm thinking that way. I promise you there's tens and thousands of other traders thinking that way. Sometimes this 200-day moving average is kind of like a self-fulfilling prophecy. I'm not buying here until it rejects the 200, which means there's a lot of other people not buying here. But if it does reject the 200, I most likely will buy. A lot of other people will most likely will buy, and that might be the end of the down, and we'll have a move back up. Don't know, but that's the thinking. So next week on UAL, looking for a close under the 200, back over the 200, a bounce at the 200, or an intraday rejection of the 200. Again, this is a deep dip buy stock trading strategy. It's one of my most favorite ones, and this is what I teach step by step in my one-on-one course. Last but not least, Exxon. Well. Exxon has moved down, I believe, about 20% off the high. Is it time to buy yet? Well, I don't want to just go in there and buy. I want to wait for a signal. And I have two potential signals here on the daily charts. One, which is simply be a close back over the 200. You can see we're under the 200. So a close back over the 200 would get me long Exxon. Now, doesn't mean it has to go up there. I have the 250 and the 300 week moving average down here. So two interesting points for me. Either next week a close over the 200, which would also get me back over the negative third ATR channel. That would add some bonus points to the trade. That's one potential. Simply a close back above the 200 and a close back over the negative third ATR channel. That's one potential. If it goes lower, then I have the potential to buy at the 250-day moving average, about 93.70. Rejection, close under, close over, or bounce. Let's take a look at the weekly, see where those levels line up. Nothing too great on these. They don't really dovetail with anything other than the lower 250 having the -2 ATR channel right underneath it. If it closes back over the 200, it's still decent on the weekly as it's still holding the 50-week moving average. But it's very important to look for these confluences on multiple time frames. So potential for me next week, close back over the 200, give me a good risk to reward ratio, and showing me that there were no more buyers under the 200, good risk to reward ratio, or if it goes lower, some kind of bounce rejection or close under, close over the 250. So real quick recap. Berkshire Hathaway on the daily, potential entry with the close over the 200. Caterpillar, some rejection of the 200 and close back over on the 200. The Dow, DIA, looking for an under 30 over 30. Russell, looking for an under 30 over 30 RSI. Morgan Stanley, just a nice gentle close above the 200. Philip Morris, close back above the 200. United Airlines, some kind of rejection at the 200-day moving average, and on Exxon, close over the 200-day moving average, or conversely, some kind of rejection of the 250. Now, what about if next week we go up and all these trigger? Does that mean I'm going to pile in everything I just showed you? No. I have a rule that I like to stick by, and it's worked for me. Even if I have 7 stocks that trigger on the same day, does it mean I'm going to buy all 7? No, I'm going to buy one. That's my hard and fast rule. I buy the best setup of the day, even if I have 7 that trigger at the day. How do I define which one's the best one? Well, what gives me the best risk to reward ratio? Look at the multiple time frames. Which one makes sense of rejections of levels on multiple time frames? What about confluences? I will pick the one that has the most confluences. So I will look for the best risk to reward ratio. I will look for the most confluences of signals, and then I will look in multiple time frames. So that is kind of my process. Even if I have 7, even if I have 10, perfect ones that trigger. I am not going to over leverage myself and get into multiple positions in one day. And it's kind of a fun game. Narrow down the best trade of the day. All right, so those are the dailies. Now let's go to the weeklies. Again, weeklies close on Friday, so you make your decision at the close. All right, let's take a look here at Dow Jones. This is on the weekly. All right, now, if I'm trading the weeklies, I want to look to the monthlies for the confluences of signals and confluences of levels on the higher time frame. Dow Jones Industrial. Okay, well, this is way down here, right? Does it mean it's going to get down there? I don't know. If it does, then I take the trade. If it doesn't, then I look for another market that gets to where I want it to get. So when I look at the weekly here, I go, okay, 200 on the weekly makes sense. I drew the line. Let's go over to the higher time frame. Any confluences there? Well, it gives me support of the 50-week moving average. We have this big up bar here. That's about halfway from a Fibonacci standpoint. That level makes sense. If you have a big, huge up bar pulling back to about halfway from a Fibonacci standpoint, you should have some inherent support. So on the weekly, 200 makes sense, gives a good risk to reward ratio. Higher time frame, does it make sense? Yes. Halfway of the washout bar. Is it going to get there? I don't know, but if it does, it gives me a good risk to reward ratio. And again, I teach all of these things in my one-on-one course. If you really do want to become a better trader, if you want to have someone that knows what they're doing and has traded for many, many years, for me, 28 years, and who loves teaching, you might want to consider taking my course. You will love it. I promise you, you're going to learn so many things. And so keep that in mind. Okay, so DIA, Dow Jones Industrial on the weekly, looking for a bounce or rejection of the 200-week moving average. Again, that's on Friday. Gold, GDX, excuse me. This is the gold miners. Now, this is a short position. Why would I be looking at a short position? Well, 200-week moving average. This dovetails with this big bar down here. Now, I just mentioned if we go up big, pulling back to halfway, you should have some inherent support. Opposite with this, if we have a big down bar and then we rally to about halfway of that down bar, there's going to be some inherent resistance. Well, that inherent resistance at the halfway bar dovetails nicely with the 200 week. See, that's the confluence. So next week, if we go above it and then close below it, I would get short. If we bump into it, pull back, I would get short. If we close over it and then close back under it, I would get short. Now, the 200 week, let's see what that looks like on the higher time frame. Are there any supporting resistance levels up there? Not perfect, but you do have the 200 week above you as some resistance. So this one is not perfect on multiple time frames, but it's not bad. So a rejection of the 200 week next week would give me possibility to get short. Goldman Sachs, well, took the trade on the weekly, did not work, but on the daily, but on the weekly time frame, the 200 way down here at 277. That's down quite a bit. Can it get there? It certainly can, especially in these conditions. Does it mean it's going to? I have no idea, but I like the level. Let's draw the line, see what that looks like on the monthly. Monthly, not bad. It would hold the lows of the previous bar's low way back here in the summer. Also have the 50-month moving average underneath it. Yeah, I would be very happy to get long Goldman Sachs if we have a bounce, an inter-week rejection, or a close under back over the 200. Doesn't mean it's going to get there. Doesn't have to get there. But if it does, it makes sense. Home Depot. Well, Home Depot has come way down. 200 week moving average looks like a reasonable place to get long Home Depot. If we reject, let's see what it looks like on the higher time frame. Yeah, support of the 50 SMA, support of the 50 EMA, support of the lows from the previous range. That all makes sense. So potential bounce at the 200 on the weekly, intra-week rejection or close over would potentially get me long Home Depot. You can see most of these stocks here are the industrials. Johnson & Johnson. Well, I have been looking and stocking Johnson & Johnson for weeks. I remember up here saying, well, if it gets to the 200, I would be interested. Well, was it likely that it was going to go to the 200? Not likely, but it is almost there, baby, right? It is almost there. We're at a low RSI level, 3258. So next week, if we have some kind of bounce on Friday, where it bounced at the 200, or it had an intra-week rejection of 200, or a close under, close over, totally makes sense. Drew the line here at the 200. Let's see where that dovetails on the weekly. This one's almost perfect. That 200 weekly dovetails with the 50 EMA on the monthly. Makes sense. I think there's a lot of opportunities in this stock, but I'm going to wait for my signals to confirm, to tell me that a level has been rejected. And if Johnson & Johnson does get rejected at the 200 on Friday, I will get long. Last but not least, XLF. Well, big move down with all the things that are going on in the banking industry with Silicon Valley Bank and others. Did not have the strength to hold its 200 here at all. So what am I looking for? I'm looking, if we go down, a rejection of the 250 on the weekly would make sense. A rejection of the 300 on the weekly would make sense. Or a close back over the 200 week moving average. Let's look. I drew the line at the 200. We are at a kind of an important level here on the monthly. We're at the 50 SMA, actually slightly under it. So it has lost that support. But if we close over the 200 on the weekly, we will also close back over the 50, and it looks like the 50 EMA as well on the monthly. Those are your confluences and signals. And again, what do I have? I have 6 symbols here. Well, these could all signal next week, but I would not take all 6 of them on Friday. I would narrow it down to the best one. So real quick recap. Dow Jones looking for some kind of rejection of the 200-week moving average. GDX looking for a short position here with a rejection of the 200-week moving average that also dovetails nicely with halfway of this big down bar back here on the 3rd. So looking for a short with a rejection of the 200-week next week. Goldman Sachs looking for a rejection of the 200-week to the downside. Home Depot looking for a rejection of the 200-week to the downside. Johnson & Johnson looking for rejection of the 200-week to the downside, and XLF looking for rejection of the 250, the 300 to the downside, or alternatively a close back over the 200 week. So that's what I have for this particular week. Next week is going to be interesting with the Fed. Try to get any preconceived notions and opinions you have outside of your head of what the Fed is going to do. They could raise, they could stop, they could cut. You just never know in this environment. But my best advice is to base your trades off your system and off rejections of levels. And if you need help with that, as I've mentioned several times during the podcast, I do teach private one-on-one lessons in the evening time via Skype. I teach you all 5 of the different trading approaches that I use step by step. It's a 15-hour course. We have 5 sessions together. Each session is 3 hours, so it's a serious course. And I teach you step by step all 5 of the different trading approaches. I use how to position size, trailing stops, overhead resistance levels, narrowing down trades, confluence of signals. It's a great course. I've taught so many people from all over the world. So if you're interested, send me an email. The email is the link in this description. If I do get an email from you, I'll reply and say, hey, how's it going? Appreciate you saying hello. Let's set up a Skype call. The Skype call is free. I promise you it is not a sales call. I don't have to sell, right? I have a lot of students, but it's just a good time for me to learn more about you, your trading approaches, your trading goals, your trading challenges, and it's a great time for you to ask me any questions about the course, right? And then when we're done with the Skype call, I won't contact you. I won't bother you. It's all up to you at that point. And later in the week or later in the month, if you liked what we talked about, if it feels good to you, then all you have to do is write me back. Say, Greg, I decided, let's do the course. We'll set up a time and away we'll go, and you're going to learn a lot. The course does cost $1,750, but it's an investment. It's worth every penny. I know you're going to be happy that you took the one-on-one course. Now, if you like online courses, I have a great, super affordable online course at udemy.com. The link's in the description of this YouTube video. I teach you step by step in video form, right? Not one-on-one, but in video form, how to trade the deep dip buy approach. We've talked about the deep dip buy approach many, many times here today. One of my favorite. And that course is super affordable. It's $12 to $15. There's a lot of content. There's 26 videos. There's 9.5 hours of video. There's 15 different study guides that you can use. And it is a great course. And for the money, you are going to learn a ton. So the link is in the description. If you like today's podcast, I really would appreciate it if you wouldn't mind hitting the thumbs up button and or sharing the podcast, maybe on your social media. It just lets YouTube know that there's some valuable content here. And, if you've appreciated this, if it's helped you, if you're learning anything in today's podcast or in any priors, all I ask is a thumbs up button. And it really would help out the channel. So I would appreciate that. And then last but not least, and always most important, please try to go out and do something nice for someone today. If we all did something nice for another person each day, even a small thing, it really would make the world a better place. We appreciate acts of kindness when it comes our way, and other people appreciate it as well. So if you wouldn't mind doing that, it would just be fantastic. It could make the world a better place. And on top of that, if I could ask one more thing, if you could please try to go out and do something nice for an animal today as well. They appreciate it. I was raised with many dogs and cats and ducks and ponies, so I'm a big animal lover, but they do appreciate acts of kindness just like humans do. So if I could just ask in return, one nice thing for another human being today, one nice thing for an animal today, and it really would make the world a better place. So next week, please be careful. We have the Fed meeting. Don't try to get into your head that you know what's going to happen. The truth is in what the price is telling you, even if that's opposite of what you think is going to happen. That's my best advice. So appreciate you coming here today. I hope you have a nice weekend. I hope you have a good rest. Maybe do some chart study, get out, get some fresh air, do a little exercise, do a little act of kindness out there. But I really do appreciate you coming here, and God willing, I will see you next Saturday as well, and we'll see how all these trades have played out. So on the way out here, I have to run the U.S. legal disclaimer, but thanks so much for coming, everyone. Take care of yourself. Have a nice weekend. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.